Hello and welcome to the first Fund Insider interview in our new recording studio. I'm Kyle Caldwell, the Collectives Editor at Interact Investor, and today I'm joined by Simon Edelston, who is the Fund Manager of the Midwind International Investment Trust. Simon, thanks for coming in today.
You're welcome.
It's been a first quarter of the year that many investors will want to quickly forget. How has the trust fared, and has there been any portfolio activity?
Well, one of the things that we said when we set the fund up was we may not always keep up with bull markets, but we structure it so that it will perform pretty well when markets fall. And so I think that a lot of our investors have noticed that the Midwind Trust has held up relatively well compared with other growth-oriented global equity funds. So some of the stars, some of the people we were lagging in recent years, we're well ahead of in terms of not giving back those gains. And that's what we always said that we'd do. And so we're pleased to be able to note that we've shown ourselves relatively good. We've always taken the view that you should run a fund so that it can cope with all sorts of different market conditions. We hope that people will hold this fund, for decades. And over decades, out and out growth doesn't always work. Value doesn't always work. Commodities sometimes go up, even banks sometimes go up. And yet investors, some investment houses seem to have decided they're only going to do one part of the market. That's never made sense to us. We've always wanted to have a remit and told our investors that we'll try to cover quite a broad range, not low quality stocks, but some unusual stocks such as mining, which an out and out growth house would never look at. And at times like this, having that balance is terribly important to make sure you've got good balance in difficult conditions. And the conditions now that inflation's up are much harder than they've been for the last 12 years. And I don't think that's going to change.
And in recent months, there's been a market rotation that's been taking place, which has benefited value shares at the expense of growth shares. What's your thoughts on the market rotation?
Well, this is effectively what we plugged into. Though funnily enough, when I talk about the balancing part of the portfolio and I talk about railroads and telecoms and mining, I don't see that in value funds. I don't see much exposure to these sectors. They're out of favour sectors. For us, they're still quality. They have pricing power. They have assets that people would give their eye teeth for, whether it's a telephone network or a copper mine. So to our mind, now obviously the mining companies are price takers, but the phone companies and the railroad companies have enormous pricing power. So you can balance a portfolio without doing this thing which is called value, which can just be buying bad companies with lots of debt, lots of ESG problems just because they're on a low rating. That doesn't strike me as being the sort of investing I want to get involved in. So our way of balancing the fund is rather different from this growth value idea. Some people might say that the cockroaches are value. I'd say that they're quality. They're just growing slower than the other sort of stocks and better value for money in this market.
And if the value rally is sustained, would that change your opinion on technology shares at all? I noticed in the top 10 holdings you have exposure to both Alphabet and Amazon.
So technology holdings that remain, having sold quite a few last year, we've got less than the index for what it's worth, and we only own some of the FANGs. So we, as you say, we own the company that controls Google, we own Amazon, and we own Microsoft. So we own three of them. We own no Apple, we own no Tesla, which we think is a very expensive share, and we own no Meta, the company that used to be called Facebook. And for different reasons. So we're selective, and overall we've got less than the index. In fact, if you take Alphabet, the company that owns Google, it's actually on a very modest multiple. It's on a traditional old-fashioned PE of about 24, 25 times earnings this year. It doesn't pay a dividend, doesn't give you a vote. All the votes are controlled by the management. But it's still growing its sales at 12%, should be able to pass on inflation. So to our mind, some of these stocks are a good old-fashioned value for money. Most of technology is still expensive to our mind. But some of the older stocks, have grown into their valuations and actually offer quite a safe haven type, stable, defensive investment opportunity.
And in terms of countries and sectors, are there any that you would pick out at the moment as being particularly attractive?
So in the changes that we've run through, the effective move from a geographic point of view is that we've ended up with a portfolio which is very based in developed markets, very underweight emerging markets, having nothing in China in particular. Strangely, we've got very little in Europe because we're worried about European recession. So the rest of the money is in Japan and North America. Really quite a lot of money in North America for us. And people say the American market is very expensive. I can find lots of expensive shares in America, I'd agree, in the technology sector. I can also find lots of cheap shares. So some of the healthcare stocks in particular strike me as very good value for money. So it's a big market. We're stock selectors. We can normally find good value for money if we look hard enough, and still in quality stocks. So that's how the portfolio has ended up being balanced.
Around 5% of the portfolio is in the UK. So I'm assuming that's a market that you're not finding much value in.
We struggle to find stocks in the themes we like in the UK. It's always been a problem. So the big themes we have, successful digital companies, successful robotics companies. Actually, there are quite a few in the UK. They're just not quoted. They're privately owned, or they're subsidiaries of American companies quite often. We're very good at this stuff, but there's nothing to buy listed in London. And then peculiarly, if you turn that on its head, the 5% we have invested in London is generally in the mining companies, which have none of their business in London at all, apart from their head office. And so, as ever, UK investing, or how much you have in the UK listing, can be slightly misleading.
The trust sold out of China last summer, which comprised a small part of the portfolio. Could you explain why? And does the political risk of investing in China now outweigh the potential rewards?
Yeah, so at one stage we had nearly 10% of the trust assets in China. So it was really quite a significant proportion of our assets going back 3 or 4 years now. And we'd made very, very good money there. We were wary that the Chinese government, having done a remarkable job for their people over 20 years, bringing up the average per capita pay, now has a very different set of political priorities than creating manufacturing jobs. It's an aging society, a very rapidly aging society, and there are rather few people going into the workforce because of the one-child policy. So you have what's called a dependency ratio issue. Fewer people working and more people to be looked after, more people aging. So the best way we thought to invest in China was through automation. A lot of those companies quoted in Japan. They're very happy to have Japanese robot makers making robots and trying to get up productivity. On the other hand, governments in that situation need more tax revenue, and they don't need foreign capital so much. So we were quite wary of any changes in regulation, particularly in the booming digital businesses, which might mean that there's less in it for us and more in it for Beijing and perhaps for the Chinese people. And that's exactly what happened. So we sold out of all of our successful digital holdings, goodness me, a couple of years ago now, or 18 months ago. And it's a good thing too, because the regulation went much further than we expected. China, unfortunately, is now in a very difficult position. It politically is a friend of Putin's and Russia, but how that will emerge from the current Russian invasion of Ukraine, how that will develop is hard to tell. On the other hand, China is still in a dispute with America about trade and about how it operates under the World Trade Agreement, and security matters and semiconductor supply and issues like that. So it's caught in a very difficult place, and we as Western shareholders are therefore caught in a difficult place. So we continue to be better safe than sorry on that at the moment. We think the Chinese economy will grow pretty well, but we get a lot of exposure to that from Western companies that we own, which sell into and very successful there, particularly these mining shares. If the Chinese economy grows, and China has very little inflation while the rest of the world has inflation, so they may cut interest rates this year while everyone else is raising rates. So some of the big commodities in the world, like iron ore, which have actually gone down over the last couple of years because the China economy hasn't been so good, might actually go up this year just on that. And the same mining shares that are benefiting at the moment from troubles in Eastern Europe could benefit from a recovering Chinese economy. And that's enough exposure for us.
And the final question, which we ask all fund managers, do you have skin in the game?
Yeah, so if you look down the shareholder list of Midwind Investment Trust, I think I've come in the top 5 anyway. So yes, quite a lot.
Good to hear. Simon, thank you very much for your time today.
You're welcome.
Do check out the rest of our video series on our YouTube channel, and please do give us a like and subscribe. We'll see you next time.